Common Stocks and Uncommon Profits by Philip Fisher. This is a seminal work in investment literature that has influenced countless investors, including Warren Buffett. Published in 1958, Fisher's book is a deep exploration of long-term investing, with a focus on identifying high-quality companies that can generate exceptional returns over time. Fisher's approach revolves around understanding the business behind the stock, developing a strong grasp of its growth prospects, and maintaining a long-term view on investments. Below is a summary that covers the key ideas and principles from this influential book. The importance of growth stocks. One of the central themes of Common Stocks and Uncommon Profits is the focus on growth stocks companies with above-average prospects for long-term earnings growth. Fisher believed that investing in companies with significant growth potential was the most effective way to achieve superior returns, rather than chasing short-term gains or market trends. Fisher encouraged investors to seek out companies with sustainable competitive advantages and the ability to grow over the long haul. Fisher's approach does acknowledge that concentration comes with higher risk, but he believed that this risk could be mitigated through deep research and a thorough understanding of each company's business model and growth prospects. He suggested that true risk comes from not understanding what you are investing in, rather than from having a concentrated portfolio. The legacy of Philip Fisher. Fisher's ideas laid the groundwork for modern growth investing, and his focus on qualitative factors, such as management, quality, innovation, and competitive advantages, has had a lasting impact on the world of finance. His influence is particularly evident in the strategies of successful investors like Warren Buffett, who has praised Fisher's work for its focus on long-term, high-quality growth investing. Conclusion: Common Stocks and Uncommon Profits offers timeless insights into long-term investing and the importance of selecting high-quality growth companies. Fisher's 15 points provide a thorough framework for evaluating businesses, and his Scuttlebutt Method emphasizes the importance of qualitative information in understanding a company's true potential. Ultimately, Fisher's advice boils down to identifying excellent companies with strong management and significant growth potential, and then holding on to those companies for the long term, allowing compounding to do its work. Fisher's focus on patience, research, and long-term thinking remains highly relevant to investors today. Good companies are continuously innovating. They do not rely solely on their existing products, but are always looking to develop new products that can drive future growth. 3. How effective are the companies' research and development efforts in relation to its size? Fisher believed that research and development (R&D) is a crucial driver of innovation and growth. A company's ability to consistently develop new products or improve existing ones is essential to its long-term success. 4. Does the company have an above-average sales organization? A strong sales force is necessary to effectively bring the company's products to market and to ensure that customers are satisfied and return for repeat business. 5. Does the company have a worthwhile profit margin? Companies that can maintain high profit margins over time are more likely to generate strong earnings growth and weather economic downturns. Fisher stressed that investors should seek out companies with durable, competitive advantages that allow them to maintain strong margins. 6. What is the company doing to maintain or improve profit margins? Beyond having good profit margins, Fisher encouraged investors to look for companies that are actively working to improve their efficiency, cut costs, or increase productivity, which will help sustain profitability. 7. Does the company have outstanding labor and personnel relations? Employee satisfaction and engagement are important indicators of a company's overall health. Companies with poor labor relations may face operational disruptions or declining morale, which can hurt long-term performance. 8. Does the company have outstanding executive relations? Fisher believed that strong leadership is one of the most important factors in a company's success. Good management should be honest, forward-thinking, and capable of executing a long-term strategy. 9. Does the company have depth to its management? Fisher emphasized that investors should not only look at the CEO or senior executives, but also consider the strength of the company's broader management team. A company with a deep bench of talented leaders is more likely to thrive over time. 10. Does the company have a short-range or long-range outlook in regard to profits? Companies that focus on long-term growth rather than short-term profits are more likely to create substantial value for shareholders. Fisher warned against companies that prioritize short-term gains at the expense of long-term stability. These points guide investors toward companies that have excellent growth potential, strong management, and competitive advantages that can sustain profitability over time. Scuttlebutt Method. Gathering information. Fisher introduced a unique approach to evaluating companies called the Scuttlebutt Method. This method involves gathering information about a company from various sources, including its customers, suppliers, competitors, and employees. Fisher believed that by speaking to people who interact with the company, investors can gain valuable insights that are not always reflected in financial statements. For example, talking to customers can reveal whether the company's products are worth, while suppliers can provide information about the company's business practices. Competitors may offer clues about the company's market position and future prospects. This qualitative information helps investors build a complete picture of the company's strengths and weaknesses, which goes beyond the numbers. Patience and long-term investing. Fisher emphasized that successful investing requires patience. He advised investors to buy stocks with the intention of holding them for the long term, allowing the company's growth to compound over time. Once an investor has identified a high-quality growth company, they should resist the temptation to sell the stock based on short-term market fluctuations or temporary setbacks. Fisher was a strong proponent of buy-and-hold investing, particularly for companies that have excellent growth prospects. He believed that many investors miss out on substantial gains by selling too early. Instead, he advised holding onto a stock as long as the company continues to meet the criteria outlined in his 15 points. When to sell a stock. While Fisher advocated for long-term investing, he acknowledged that there are times when selling a stock is necessary. He provided 3 primary reasons for selling. 1. The original reason for buying the stock is no longer valid. If the company's growth potential has diminished, or if its management is no longer effective, it may be time to sell. 2. A better investment opportunity becomes available. If an investor finds a superior growth stock, they may consider selling an existing position to free up capital. 3. Personal financial needs. Sometimes, investors need to sell for personal reasons, such as funding a large purchase or covering unexpected expenses. However, Fisher warned against selling stocks purely because of short-term price fluctuations or macroeconomic events. He argued that investors should focus on the company's long-term prospects rather than reacting to market volatility. Diversification and risk. Fisher had a somewhat unconventional view on diversification. While many investment experts recommend broad diversification to reduce risk, Fisher believed that investors should concentrate their investments in a small number of high-quality companies that they have thoroughly researched. He argued that holding a few carefully selected growth stocks can lead to better returns than spreading investments too thinly across many companies. Fisher's approach does acknowledge that concentration comes with higher risk, but he believed that this risk could be mitigated through deep research and a thorough understanding of each company's business model and growth prospects. He suggested that true risk comes from not understanding what you are investing in, rather than from having a concentrated portfolio. The legacy of Philip Fisher. Fisher's ideas laid the groundwork for modern growth investing, and his focus on qualitative factors, such as management, quality, innovation, and competitive advantages, has had a lasting impact on the world of finance. His influence is particularly evident in the strategies of successful investors like Warren Buffett, who has praised Fisher's work for its focus on long-term, high-quality growth investing. Conclusion. Common stocks and uncommon profits offers timeless insights into long-term investing and the importance of selecting high-quality growth companies. Fisher's 15 points provide a thorough framework for evaluating businesses, and his Scuttlebutt method emphasizes the importance of qualitative information in understanding a company's true potential. Ultimately, Fisher's advice boils down to identifying excellent companies with strong management and significant growth potential, and then holding on to those companies for the long term, allowing compounding to do its work. Fisher's focus on patience, research, and long-term thinking remains highly relevant to investors today.